We're going to wrap up Chapter 3 with a quick look at the federal income tax system. Now, we know that both individuals and corporations pay taxes. If your business is set up as a sole proprietorship, a partnership, perhaps as a limited liability corporation, a limited liability partnership, or a subchapter S, all of the income is funneled to the owners, and then they pay taxes on that income. The business itself does not pay taxes. So hence, individual taxes for those sorts of businesses that's important. And then, of course, corporations, since they're entities unto themselves, they have their own tax rates. The book is written from the standpoint of a corporation. We're going to look at this. So in December 2017, there was a sweeping change of all taxes, all tax laws. For corporations, rather than having a progressive tax rate schedule where higher levels of income were taxed at higher rates, now corporations pay a flat tax rate of 21%, regardless of whether you have $1, whether that corporation has $1 in income, or if they have $1 million in income. All corporations pay the same tax rate. Corporations may also be subject to state taxes, and that might be around 5%. The new tax law says that interest on borrowed money is now going to have a deduction, is now going to have a limited deduction, whereas before corporations that borrowed money could expense or deduct all of the interest on borrowed money. Now there's a limit. Business interest deduction is now limited to 30% of a firm's earnings before interest, taxes, depreciation, and amortization. And that's true between the tax years 2018 and 2021. It will go to 30% of earnings before interest and taxes after 21. There's a couple of that's very interesting when it comes to whether or not something is deductible for a corporation or not. Let's look at interest. As we said before, when a firm pays interest, that means that it borrowed money. And now the tax law says that there is a limit on how much that they can deduct, 30% of operating income. But when a firm earns interest, that must mean they lent money, they invested in some sort of security that pays interest. That interest that's being earned by a corporation is now fully taxable, unless they earn interest from a municipal bond, which is tax-free. What about when a corporation pays or receives dividends? When a firm pays dividends to its stockholders, it has no tax effect because dividends are paid out of after-tax income. In other words, out of net income. So there is no deduction here. It's paid out of after-tax income. In other words, after all the deductions, after the taxes have been paid. What about when a firm receives dividends from another firm? Certainly one corporation can invest in the stock of another corporation. Well, to avoid triple taxation, there is a way out, in that when one corporation receives dividends from another corporation, 50% of that dividend income is excluded from taxation. Some more tax issues involve the tax loss carry forward. And that means that if a firm experiences a loss in a particular year, they can carry it forward to offset any profits they have, and that would reduce their tax liability to the IRS. Another issue has to do with capital gains. Capital gains are defined as the profits from the sale of businesses not normally transacted in the normal course of business. Capital gains usually result from the sale of a long-term or a fixed assets. Corporations do not receive special capital gains treatment. In other words, when they experience a capital gain, it is taxed at that flat rate of 21%. That's not true for individuals experiencing a capital gain. There is a concept clip in Chapter 3's video reviews about capital gains that you may like to take a look at.